Now, as mentioned before, it's going to become more and more important to begin allocating your money into bonds and not just equities as you get older. So I wanted to include a bond fund on the list here as well. This is the Fidelity US Bond Index Fund, and this is going to be a much lower rate of return because the idea with bonds is just to preserve your wealth and outpace inflation, not so much looking to have the potential for upside, but also a lot of downside. So over the last year, that's a 3.3% return, and the 10-year performance here is at 1.41%. However, take a look at the yield here in this case, which is coming in at 4.41% because bonds are mostly about the yield being paid out in those dividends and not so much returns being generated from the underlying value of the shares. And if we take a look here at the composition, we can see that 40% of this is in US Treasuries. We see 26% in corporate, and there's also some money in mortgage-backed securities. I don't see any municipal bonds represented here, but the three categories of bonds are going to be your municipal bonds, corporate bonds, and then US Treasuries.